Good morning, anyone out there. We'll be getting started in just a moment. Actually, it's time. We'll get started right now. My name is David Moore. Thank you for joining us today. And this presentation is the first time I've given this particular presentation. So it's one that probably is going to take a little bit more than an hour. If you have to go, I understand. Apologize, but I just had too much content, not enough time. Usually I spend a couple hours going over what I call the fun stuff. So if you're sort of new to this process, you're probably going to get buried pretty quickly. This class is something we encourage somebody to watch or participate in one of our basic classes before going to this one. If you haven't been to one of those, you're probably going to be walking off this call with more questions than you've got answers to. So the idea here is a lot of times people are told they can or can't do something, and we're gonna sort of shed some light on some opportunities out there. I call it the fun stuff because after 30 years in the business, it would be easy to get bored with a basic set of rules and a basic set of transactions. But this is the type of stuff that requires a little bit of gray matter. We have a lot of fun doing it. And you know, it's a lot of times it's like, oh, I didn't know I could do that. So once again, David Moore with Equity Advantage. A little housekeeping real quick. We will get the handout out to everybody after the presentation. If you are in need of continuing education, then please reach out to C-Moore, C-M-O-O-R-E at 1031exchange.com. If you're in Oregon, we're going to get you the CE for that, real estate CE. If you're in other states, don't hesitate to reach out and check in with her, and we can do what we can. You know, maybe we can help you get some credit hour too if you're a real estate professional. But you know, the idea is here. A lot of times, lots of misinformation out there with 1031. We're going to talk about some things that I consider fun. We're going to talk about notes in an exchange. We're going to talk about holding periods, which very important right now with all the chaos out there. We're going to talk about improvement exchanges, even building on property that you already own. We will talk about the biggest issues with partnership transactions. We're going to start off with just laying some basic, base knowledge. We'll go from there after that. But buckle up, we'll have a lot of fun. If you've got questions, that on the right-hand side, there's a menu there. You can type in a question. If I've got time, I'll get to it. If not, we'll be addressing any of those questions after the call. But thanks again for joining us today. And without further ado, we are off. So Advanced 1031 is the fun stuff. The reason, like I said, I call it the fun stuff is requires a little bit of thought. And it is a lot of times we're talking about doing things that people have been told they can't do. So it is fun. Think about it that way. And anytime we're able to save you money, it's fun. So anyway, here we go. First off, why real estate? Why real estate today? And obviously there's segments of the real estate market that are going to have some very serious problems. I actually, broadcasting from Portland, Oregon today, we've been in the news a little bit, and we've got our own share of issues here. And especially if we're talking about rental houses in Multnomah County, or even statewide with the rent moratoriums and everything else that's going on there. So we've got a situation here where maybe you just bought a property, and here's one of these fallacies, right? I mean, overcoming the fallacies. So a lot of times people ask, well, how long do I have to hold the property, have it considered, applicable to 1031? Or if I buy something, how long do I need to hold it? And I hear 2 years floated all the time out there. That's gibberish, okay? 2 years is a timeline that applies to a related party transaction. We'll talk about related parties, what you can and can't do during this presentation, so I'm not going to beat on that any right now, but there's no stated required hold in 1031 for an arm's length transaction. There's a court case that came down, it seemed like yesterday, but now 2012. We're going to talk about that in the holding periods segment, the Resync case, and the people basically bought a property with the quote unquote intent to hold for investment, and circumstances changed. They had documented showings and listings, and they moved into it after 4 years and actually successfully defended after audit and court case. So, once again, if it's an arm's length transaction, there's absolutely no such required hold there. And in a situation now, you might have just bought something, and if you bought it I'm just going to pick on Multnomah County again. You might have just bought the thing and now you got a tenant that hasn't paid you and they're not going to have to pay you till next spring and you're not too happy about it. Well, I mean, if you could find a buyer for that asset, you could get rid of it even now, just citing all the repercussions of COVID and the hardship and so on and so forth. And you should be able to rationally defend anybody's question on that holding period. So we'll talk about that stuff really in the context of seasoning and converting assets. But tangible assets, what is real estate considered in the investment world? It's considered an alternative investment. And I mean, that's crazy. I mean, name an older investment than real estate. In the history of mankind, name something that's older. I mean, maybe metals would be the only thing. I don't know. But if you look at metals, I mean, a tangible asset, we all hear the ads, see the ads on TV, hear the ads on the radio for tangible assets, buy silver, buy gold, buy palladium, buy platinum. Well, platinum, not so much right now, but if you look at that stuff, you know, what are they selling? They're selling tangible assets, inflationary hedges. The ultimate tangible asset, inflationary hedge, I believe, is real estate. And you know, one of the reasons I talk about that is even with the precious metals, you've got to convert that thing at some point if you want to use it, and you're solely betting on an increase in value to make a return. Where real estate, at the end of the day, I was always taught never to bank on appreciation, but you know, typically you're going to have it. You know, it's all a question of time. If you have to sell in a bad time, you're going to lose money, but over time, it's always going to be going up, but it doesn't have to go up. If you look at this list, we've got cash flow, leverage, interest deductions, mortgage pay down, depreciation, appreciation. Like I said, don't bank on that, but all those other factors are going to apply and they're all going to help you out whether the property goes up or not. You've got somebody else making those mortgage payments for you if it's an income property. So I'm a real estate guy. I joke that half the time I spend in professionally, I feel like I'm selling real estate to real estate people, but you know, it's not an alternative investment. I really get a kick out of the investment world and how they term things. I mean, if you look at the last crash, we had synthetic derivatives that caused the issues, and yet those are a real legitimate investment. And here we've got real estate and alternative investment. It drives me crazy. So I'm a real estate guy. I like it. Look at this list. These are all reasons. There's other reasons too, but you know, it's not easy. Real estate's not an easy thing to work with, and it requires work. And I think that's one of the issues right now. Is if you're going from a state that's got high rent control, you're probably giving it up because you're just done with that state. And you need to find a place that's, you know, those states are very expensive for property owners to own an asset. And a lot of times those tenants have more rights than the property owner does even. So we've got lots and lots of money moving from, let's say, the West Coast to elsewhere in the country, any of those states that have you know, little or zero state taxes. Obviously, they're attractive for people, but mostly people are just going to where an owner of a property has some right of ownership once again, because it's really just gotten out of hand. So why real estate today? This is a list. We're not going to spend any more time on that. What are you selling? This is a great question. If you're a commercial broker, you're saying, look, I don't really care about Section 121. That's the universal exclusion for a home sale. And if you're a residential broker, you're saying, well, really, I don't care that much about 1031. Well, both of you should be aware of both codes and understand, because if you're a commercial broker working with an investor that's got lots of commercial property, they probably have a very expensive home. If their homes have gains in excess of 250 or 500,000, single or married, you know, they're going to have a huge tax hit. On the other hand, you know, maybe you're giving up properties and you just you're tired of the income properties and you go buy a place to live in, or you know, you're just tired of it all. You can convert investment properties to residential property. You can primary residence even, as I said, with that Racine case, and you can go the other way too. A lot of times, if you've got a very expensive house, the gains are in excess of the 250 or 500. We're going to tell you to move out of the property, hold it as an investment for a period of time. That period is up to you and your tax people. There's, you know, there's no black and white hold there. Once again, it has to do with intent and what circumstances are. Even Section 121, it says you have to have lived in the property for 2 out of the preceding 5 years. The only way you get a proration of the 250 or 500 is if there's a hardship for sale. You can't just electively take a proration based upon, oh, maybe I held it for 3 years, or maybe I lived in a year. So you really have to understand what that thing says. But what it does say, I want to be clear about this, Section 121 applies to any property that fits that 2 out of 5 as residency. So you could move out of the property, have it as an investment for just shy of 3 years, sell it, take the exclusion, and 1031 the overage. So be aware of that. And it's not, Section 121 is not what the asset is at time of disposition, is whether it fits that 2 out of 5. 1031 only applies to property that's held for investment at time of disposition. Totally different situation. So you've got to be careful on what you're working with. You can have, think of a single asset that might contain 121 and 1031. Well, a duplex would be a great example, half owner occupied, half investment property. What about a situation where you've got maybe a large estate, you've got that house and you've got the working land? Same situations, you're going to have allocations 2 different directions in that situation. What about, here's one that sneaks by people all the time. Anybody out there have a home office? You got a home office, you sell your home. If you've been treating that home office as such for more than 3 out of the last 5 years, it no longer fits the exclusion, and you need to do an exchange on that portion of the home. Does it ever get done? And I would argue it rarely gets done unless somebody's got large enough allocations there. I've got a real estate lawyer we've done a lot of work with through the years. He's somebody I did a leasehold improvement 4 years ago too, but he's given up his home, very nice home, but he's got a big home office there. The gains on his home sale were well in excess of the 500. He's married, and so we carved off that home office portion. We're doing an exchange of that piece. When the home sells, we're doing an exchange of just that home office component, and the balance of the money's going to him via the universal exclusion. So those are all examples of flipping things. You can look at it. What is it? What do you really want it to be? But I would look at this chart anytime you've got a listing. If you're a professional, think about that. If you're an investor, look at this chart. Every time you sell a property, what is it? What do you want it to be? How are you going to keep your money yours? And that's where, if you look at our industry, and as I said, I've been in it almost 30 years now. And when we started the company, my brother and I, it was a situation where everybody in the business was very knowledgeable. They were investors. There were people with tax or legal background, things, that were, really important to the process, because it's rarely a black and white situation when we're looking at tax law. And that whole thing has changed in 91, and in fall of 91, we got some guidelines that allowed, a sort of a drop in the bar of the people involved with the business. And today, a lot of times exchanges are just looked at as an additional escrow function, and they're thought of as the last second. You're doing yourself a very, very large disservice if you're waiting till the last second to think about what's going on. We tell people all the time when they ask us, when do you want to think about an exchange? I'm going to say when you're buying the property, because I know you're not going to own it forever, and how you own that property is going to dictate how you relinquish the property in the future. But answer 3 questions when you're going to buy the property. What am I going to make? When am I going to make it? How am I going to make it? If I can't answer the questions, don't buy it. And Jared, if you're out there, you've heard your dad say that many, many times. But the idea is have a plan. Make that plan and work through the plan when you're buying the property, and that way you're going to save yourself a lot of heartache. Sorry, I had to start my timer. I'm so excited to talk to you guys, I forgot to get it started. Seasoning, how long is long enough? Now, I've hit this point, and I've got lots of material, so I'm going to race through this page. We talked about it a little bit previously, but that resync case, that's mentioned up at the top, that's the court case. That's where 4 months was deemed long enough. They bought a property, gave up an investment property, bought a new investment property, tried to rent it, and after 4 months decided they could no longer hold it sitting there vacant, and they were in a situation where they moved into it, and they successfully defended that action after 4 months. So sort of an extreme example, but if somebody's pushing me on how long something should be held, I'm going to tell you a year. I'm going to tell you a year based on 2 factors. One, the break between short and long-term tax rates on assets held for investment, at least for now, is at 1 year. And I say at least for now because we've got an election coming up, and if we look at what presidential candidate Biden wants to do, he's talking about elimination or a tremendous increase in capital gains tax rates. And I got to mention also, you got to understand, there's also he's put out there in his tax proposals that elimination of 1031 exchanges, which everybody on this call is going to be impacted by, obviously, and also an elimination of the stepped up basis with respect to, real estate, assets being transferred after death. So those three things are going to be potentially devastating to the real estate market. You think about, a lot of times Wall Street says, well, gee, we don't have tax deferral, so why should you with real estate? And I would argue quite the contrary. And as somebody, I work in two industries. I work with 1031 exchanges. We've got a sister company, IRA Advantage, that does retirement accounts for people that want to diversify outside of Wall Street. So, what I'm saying is a little bit contrary to that. But if you look at Wall Street, you've got trillions of dollars of qualified money, IRA 401k money that has the ability to grow totally tax deferred. And that, if you get rid of the 1031 exchange, real estate's going to have a huge handicap. We won't have anything there. I shouldn't say you won't have anything, but you're going to have to talk to me about using your IRA or 401k plan if you want tax deferral with real estate if that goes away. Think about it. 1031's been around since the 20s. It's almost 100 years old. And I would argue, even though it's looked at as something the wealthy use, I would argue it's probably the only tax tool that anybody can use. You don't have to have tax or legal advice to, put an exchange together for $1,000. I mean, it just doesn't cost you anything. Anybody can do it. It's not complicated, and it's a tool for anybody. It's a tool for the middle class to grow their wealth and keep their money yours. We like to say you've worked hard for your money. We're going to work hard to keep it yours, and that's what 1031's about. IRA's 401k plans, obviously the same situation. You're keeping it's pre-tax money growing tax deferred. A Roth is just tax money growing tax free. Think about real estate. 1031 goes away, we lose that ability. So it's really critical that we think about that going forward and really do what we can to preserve this tax code. And this isn't just coming from my perspective as a practitioner, and I use this thing too. That's how I got into the business, is application of this tax code. So when we're looking at a transaction, you might have bought something that's not working out, you can get rid of it. There's nothing saying you've got to hold it for any specific period of time. You just got to document what has happened with it, why you're doing it so shortly, and you want your tax people's agreement to it. You don't want to do something your tax people aren't comfortable with, and the first time they hear about this action is April 14th. Give them the opportunity to help you. And by the way, we're just one member of a successful team of investment professionals. I'd say your tax people are one of the most important people in that team, because, and you want to use them. Don't do it at time of sale, but you need to, first thing you got to do anytime you're contemplating a sale, understand what the tax liability is going to be if you don't do an exchange. If you just sell, what's it going to cost you? Only then can you rationalize that exchange. 4 basics, real quickly, okay? I'm not going to spend much time on these. It's got to be an exchange. You're going to give us something, we got to give you something back, all right? As far as the process is concerned, you're literally selling a property with a provision in the purchase sale agreement that entitles you to do the exchange. Typically, it could be a right of assignment, or you're going to put something in there. Maybe buyer agrees to cooperate with seller's 1031 tax deferred exchange at no additional cost, liability, or risk, something like that. I mean, whatever you want to put in there is fine. Most state forms include some type of provision in the purchase sale agreements. The problem with the boilerplate ones is a lot of them are just there and they say the buyer or seller have the right or option to do it. They don't even have a box to check. So I would caution you on the sale of a property, if you don't have something in there saying you're going to do it, and escrow is not told you're going to do it, it could fall through the cracks. You've got to get this thing set up. Even though the code's almost 100 years old, you would not believe the number of people that call us a day after closing. This has to be set up pre-settlement. If you've got actual or constructive receipt, you're going to have tax exposure. So first off, it's an exchange. You're going to give us something, we're going to give you something back. The exchange is between the exchange company and you. It's not between you and the buyer or you and the seller. The deeds are going to go straight between you. But as far as ownership, it flows through us. The exchange is between you and the exchange company. 2, the items relinquished and received must be of like kind. This is very, very often misunderstood. I had a call that I took this morning at 9:15, a conference call that we were going through things. And once again, people were told that they had, if they give up a rental house, they got to buy a rental house. That's not true. It refers to the nature of the investment rather than the form. Any real property held for investment is like kind with any real property acquired with the intent to hold for investment. And those things can be changed over time with the seasoning once again. So you can give up a piece of a single family rental and go buy a piece of dirt. You can give up the dirt, buy an apartment building, buy an office building, a strip mall. Any of those things are going to be of like kind of a place at the beach to move into. Once again, in that situation, you're going to buy it, you're going to season it for a period of time, then at a later date you can move into it. Be aware the government has ratified that process by putting rules in place. So do not sell that property inside 5 years of acquisition. It would be a fully taxable sale. And then thanks to the Housing Assistance Tax Act, you got to love the way they name stuff. You're never going to get a full use of the 250, 500 the universal exclusion contains. You're going to get prorations of those numbers based upon the qualified versus non-qualified use period. We could have a seminar on that topic alone. But be aware you can move things back and forth. 3, for you to be totally tax deferred, you need to go across or up in value and equity. And one of the biggest fallacies I hear all the time with 1031 is people say, you got to replace debt in exchange. You got to replace debt in exchange. Totally untrue. Debt can go away 2 ways. One, by going down in value. That triggers tax because you went down in value. The second way debt goes away is by adding cash. So you can always add cash to an exchange. You can offset mortgage boot, a reduction mortgage with additional cash. You cannot offset cash boot with additional mortgage. So the government does not want you pulling cash out of the transaction. Do not, with that in mind, do not do a cash out refi immediately pre-disposition, because the government could look at that as a step transaction. It is possible, though, to complete an exchange, do a cash out refi of what's been acquired, and then take that additional money, tax free, and you could go leverage it into things. So maybe if you gave up one property, you want to go out and buy 5 properties. I might tell you, look, if we can get 1 or 2 properties that satisfy your exchange, just buy those things outright, do a cash out refi of those properties after acquisition. You then take that money to do the further leverage. You've got 2 benefits. You move the time constraints. Second, whatever you buy with the refi money, the basis in those properties is going to be the purchase price. It won't be the basis carried forward out of the relinquished property. So if you've got questions on that, I'm happy to talk to you about that too. And once again, like withholding and what's happening with seasoning, you've got to look at that short and long-term tax rates. You've got to understand if you're holding stuff for resale, you're going to be, doesn't matter how long you owned it, you're going to be looking at normal income tax rates. So seasoning, we've got to look at how long you've owned it, what your intents were, so on and so forth. We're going to talk about the Clarkowski court case, and it contains 9 points that we use to determine dealer status. We'll talk about that a little bit later, and that'll further sort of help you understand what we're looking at with respect to looking at whether a property qualifies for 1031 or does not. And one last comment on the napkin test. It's not all or nothing. If you want to pull some money out, take a trip, you can pull some money out, take the trip. You're going to pay tax on that money out. So the first money out is always the government's. You can't say, okay, my tax basis was $50,000. I can pull that, I'm entitled to 50. No, you're not. You're going to get that 50 free after you pay tax on all the gains. So don't think of it in that way. And if you ask why, well, it's government, right? They want their money. 4, we have to have continuity of vesting. If we look at the 2 biggest headaches with an exchange, first is always going to be time, second is vesting. And that just has to do with how you're owning the property. The taxpayer that relinquishes property has to receive the replacement property. So we're going to look at how the property is deeded, and understand the deed in and of itself is not going to indicate ownership. If I sold you a property on a land sale contract, I've got ownership. I don't have ownership. I've got the deed until you pay me off, yet you own the asset. So you've got to look at it and understand title doesn't necessarily indicate ownership. And if we've got a transaction we know is let's say 2 spouses, husband and wife, giving us a property, and we get a title report and just says the wife's on title, and we're going to set up the exchange in the person or entity that's on title. But in that situation, we're going to ask, okay, is there a reason we want to, or they want to put the spouse on title, that property on the acquisition? A lot of times they want to. I've had people quit their jobs in the middle of an exchange. It's hard to get financed on the acquisition if you don't have a job. So don't quit your job in the middle of an exchange. But so you might have to add the spouse as a guarantor, or if we're going to put them in there, we might ask, okay, gee, have you enjoyed the economic the benefits and burdens of ownership, and how long have you been married? If you've been married for 10 years, you're both filing jointly. even though both of you aren't on title, there's an argument there to add the spouse there immediately predisposition. You're just doing a correction deed of that situation. You can rationalize it because you've both enjoyed the benefits and burdens and seasoned the property as such. But if we're just going to add the spouse to the replacement property purchase, that spouse needs to come in with money representing his or her ownership interest in that property. Otherwise, it's going to be boot taxable, any 1031 funds going to that ownership. So those are just two examples. The biggest problem probably with continuity of vesting is when we're looking at partnership exchanges. We've got a page talking about that. Now, I know I spoke quickly on these 4 points. So we've got a page that further clarifies each of those. The first one, what's an exchange? It talks about that. The second one talks about the like kind and gives you some pictures there. At 10 o'clock on this slide, I just want to mention we've got a 30-year leasehold interest up there as like kind. So 30-year leasehold interest or a lease with extensions to 30 years constitutes ownership of real property. That's why that's on there. Furthermore, it says build to suit. And when we get to building, improving property already owned, we're going to talk about that a little bit further. Napkin test, just going to further clarify it, cross her up in value and equity. And then finally, this page is talking about the continuity of vesting. And if you look at the bold at the bottom, it says when buying an investment property, plan for the sale. So you understand tenancy in common is the way we want to own an asset if we're going different directions at disposition, or if we've got people, a variety of people exchanging into an asset. Once again, it has to be tenancy in common. Partnership interests are specifically prohibited from 1031 treatment. Timelines, 45 and 180 days. Both times start at settlement. It's not 45 and 180, it's a total of 180. That 45-day, the only way we have an extension with it is with a presidentially declared national disaster, which we've had a number of recently. So we've never had an extension pre 9/11, but since then, this is the way it's been going. If you're on our newsletter list, or if you want to be on it and you're not on it, reach out once again to see more at 1031exchange.com, CMOORE at 1031exchange.com. She'll get you on our email newsletter list. But anytime we get an extension, we get it out to the people on those lists. And they've been happening a lot. We had one for COVID early. That wrapped up a few months ago. We've got them for fires, we've got them for hurricanes. We haven't seen an earthquake yet, but who knows? That's probably next for wonderful California down there. I don't know. It's crazy, crazy times. So no extensions, 45 and 180 days. How do you identify a property? This is one of those things that's very, very often misunderstood also. And I want to point to that bottom in bold, each rule works independently of the others. You only have to satisfy one of these. So you've got 3 different identification options. For an identification to be valid, it's got to be what the government would deem an unambiguous description of the property or properties you intend to buy. What does that mean? A common address would work as long as it includes city, state, and zip. If you're going to buy a condo, it's got to be a specific condo. It can't be just a unit of a complex. If you're going to buy a piece of something, so let's say you and I are going to go out and buy a property together. Well, you need to identify the portion of that property you're going to buy, because what you receive has to be quote unquote substantially the same as what was identified. So we're dealing with 2 sort of, fairly ambiguous descriptions there. Unambiguous in that, we need a specific unit, that one's tight, but as far as substantially the same, what does that mean? And we're going to tell you if you ID the whole thing, you better pick up 50% of it or more. If we're looking at a lot of times something called a DST, Delaware Statutory Trust, is something that's real popular right now. They're totally passive investments. And if you're buying into one of those, you need to ID the offering and the amount of that offering that you're going to buy. And different companies have different policies as far as how they feel that identification works with a DST. And I'll sort of explain that further in a minute. But the first rule says you can ID up to 3 properties of any value. That's pretty clear. 3 properties, that's it. Second rule says you can ID more than 3 properties, but the total value of the properties ID can't exceed 200% of the relinquished property's value. What's a property worth? We look at the relinquished property, we know you're just going to double that gross sales price. But what are those properties worth that you're buying? Are they what are they listed at? Are they worth what they were listed at? Are they worth what they're taxed at? Are they worth what you intend to buy them for? And I would argue that third point. And a property does not have to be on the market to be identified. I mean, do you have to have a property on the market listed with somebody to buy or sell it? I'm sorry, guys out there that are brokers, you don't have to use a broker for every transaction, obviously. But it was sort of interesting because back in, I think it was a 1990 or 1991 audit manual, the IRS was actually asking, was the property listed at the time of identification? And that's totally an irrelevant question. I mean, it doesn't have to be on the market as far as listed at all to be available. So you're going to identify the property and what put a value on it if you're working with us, what you intend to buy, and you're going to be looking at that 200%. The third rule says you can ID more than 3, total value can exceed 200%. You got to close 95% of the aggregate value of all properties identified. That gets very, very difficult. I'm going to tell you, if you're looking at the 200% rule, do what you can to buy all those properties, close them all inside the 45 days, because you could ID 10 properties, have one sale fail, and blow the 95%. So that thing is very, very tricky. I guess my biggest piece of advice, like I said, is to buy what you can inside the 45 days. Don't let any of these ID rules apply to your situation. So be that proverbial monkey, right? And what do I mean by that? The monkey hangs on to the old vine until he got the new vine in hand. So in this situation, don't agree. If you put a property in the market today, this weekend, somebody comes in, makes an offer that's too good to pass up, they want to close it next Friday, your first thought is, hey, that's great, sounds wonderful. If you don't know where you're buying, you don't want that thing to close next Friday. So ask for whatever time you feel you need to get your properties closed, find what you want to buy, and make sure you can do those things inside the 45 days. We've got lots of transactions that the sale and purchase will happen within a couple of days of one another. We also have properties that happen on, the acquisition happens on day 180. So it's really critical that you think about this stuff. Ask for whatever time you feel you need to get yourself where you want to go. Actually, back to the ID thing. So identification, who has to get the ID? I mean, everybody assumes it's the exchange company. It's not. It doesn't have to be the exchange company. I'll tell you, you should get it to us, because if you're ever audited, they might be calling us. If we don't have an ID, they're probably going to have some questions. But it could go to anybody that's a part of the transaction without an agency relationship. Maybe it's the seller. Maybe it's the seller's broker. It can't be your broker. It could be escrow. But it just, like I said, nobody with an agency relationship. When we close the relinquished property, we're going to send an ID pack, gives you the 45 to 180 days, says how much money we're holding on your behalf, gives you the ID rules and a form to be filled out. Get that thing filled out, get it back to us. That way it's sitting in your file. If anybody's ever got a question, it's there. And we get calls from people all the time. They're tax people, a year later, 2 years later, 10 years later, they're wanting documents from us, and the stuff's in there. So my advice, once again, it doesn't have to come to us, but it needs to go to somebody that's a party to the transaction without an agency relationship. This page is critical in today's world. When can I get my money? So let's say you start the exchange. And a lot of times, if I had 2 hours, I'd be talking about trends today. What's going on? What do we see? And I did mention we're going lots of money moving from, I'm going to say it, blue states to red states. But and that's just a lot of it has to do with rent control issues. But if we're looking at transactions, especially now, you might have set up an exchange and you're just saying, gee, the market's so hot, I can't really find what I want. A lot of times people just buy the 45 days to see if they can find something and figure it out. So as far as that and its occurrence, that 45th day is critical in today's world, because if you want to terminate the transaction, okay, so if we set up the exchange, number one, if you want to pull money out, when can you do it? 1031's not all or nothing. As I said earlier, you can pull money out. It's not going to sink the exchange. The money coming out is considered boot. As soon as boot exceeds, the total amount of boot exceeds the total gain, then there's no benefit to the exchange. So if you had $50,000 in boot and you had $100,000 in gain, you deferred half the gain. If you have 50,000 in boot and you only had 40,000 in gain, there's no benefit to the exchange. But as far as getting money out, you can get it out at settlement or after you've acquired everything you have the right to buy. All right, that's called the 1031-G6 rules. So after we've gotten your money, let's say we're day 30 and you say, look, I'm not finding anything out there, David. I'd like the rest of my funds. I'd like just, terminate the transaction, give me my money. Well, if you've identified something, I'm going to tell you to write, rescind the identification. Now, when we get to the 45th day, you don't have anything ID'd. On day 46, you have not identified anything. You didn't meet the identification rules. Therefore, you're entitled to all your money. Now, let's say we get to the day 46 and you did not rescind the ID, and you've got all that money there, and you said, gee, I'm just going to put this property on there just in case. I don't know if I want it. I probably don't want it, but I just in case, I'm going to list this property as an ID option for me. Now we're on day 46, 47, day 60. You say, you know what? I don't want to complete the exchange. Maybe you've got this OZ, opportunity zone situation. Opportunity zones, you only have 180 days too to get that money into them. So if we're going to hold the property or that money, let's say, after that exchange, if you didn't rescind the ID on 45, you had something ID'd to buy, and you don't want that property, we cannot give you your money till day 181. So it's really critical today that you understand those timelines, and that when you get that 45th day, you're 100% committed to completing the transaction, or you're going to torpedo the thing. Don't identify something just in case. All right. So a delayed exchange, you sell first, buy later, right? You've got the 45, 180 to complete the transaction. A reverse exchange allows you to buy first and sell later. All right, and if I look at this transaction, and we had done, we've always done reverse exchanges since we started the company. So, we got guidelines. A lot of people just started doing reverses. In 2000, we got RevProc 2000-37, and it contained framework for exchanging. Now, I personally am not a big fan of how they set these rules up, and they really stuck it to us on this because it would have made sense to do what we would call a true reverse. You would have, in a delayed, you're giving us property, we sell it, you tell us what to buy, we buy it, we give it to you. Reverse, why wouldn't it have been okay if you just showed up the purchase with the money required to buy? In effect, that was loaned to us. We buy the property, we give it to you. When your property sells, you give it to us, we sell it, we take those proceeds, repay the debt we had to you. That would have been a nice logical transaction. And we could have applied the 45, 180. You got, instead of 45 days to ID what you're buying, you got 45 days from acquisition ID what you're selling. So when you're looking at the 200%, 95% rules, those are sort of screwy when we're looking at reverse exchange, but that's what the rules state. So think about this. If we're in a situation where we're using RevProc 2000-37, the government said you cannot own the new and old properties at the same time. That's one of the safe harbors. So what we have to do is warehouse a property. What that means to you is we're going to create a limited liability company that's going to take ownership of either the new property or the property be relinquished. If we do what's called a warehouse relinquished, that means we're creating the LLC to park or warehouse the relinquished property. If we're doing a warehouse replacement, we're doing the LLC to warehouse the replacement property. And that LLC, when we're applying it to improvement exchanges or reverse exchanges, sort of the industry acronyms, and EAT. I was on the phone with somebody yesterday, and they go, all these acronyms, it's crazy, and it is crazy. So an EAT, for those on the on this call, is just an exchange accommodation title holder. It's a single member limited liability company with a facilitation company as the member. That's all it is. It's nothing different. So bottom line, taxpayer can't have ownership of both new and old at the same time. How do we decide between a warehouse relinquished or warehouse replacement transaction? That's going to be driven by a couple different factors. What the expected net equity is out of the old property versus what's available to purchase a new property. The second component is going to be, is there financing involved with the purchase? Because if there's financing involved with the purchase, the lender's probably going to want the taxpayer on title. All right, if the taxpayer is not going to be on title, this is the way the structure works. A warehouse replacement is easier for us. A warehouse replacement is really the same structure as an improvement exchange, and it allows us to build things during that time of ownership. So warehouse replacement means that we're going to create the LLC at time of close. We're going to be on title of that property via that single member limited liability company. From that date of acquisition, the taxpayer is going to have 45 days to ID what's to be relinquished, 180 days to actually relinquish that property. The nice thing about the warehouse replacement, in addition to the fact that we can build on it, is that we can pay down debt pre-transfer to our client. So when we have a transaction where the taxpayer, our exchanger, has less money to buy the property than what they expect to net out of the relinquished property, we're going to want to do the warehouse replacement. We're going to require a lender that's going to allow this to happen. Basically, you, the taxpayer / exchanger, are going to negotiate the purchase, secure financing as you normally would. But when that property's closed, it's going to be in the name of the entity that we're the member of. So you're going to have a loan still secured by that asset to the LLC, non-recourse to the LLC, guaranteed by you, the taxpayer. So you're going to need a lender that's a portfolio lender, somebody that's keeping that loan in their portfolio that, before they do something else with it, or they're just going to keep it, period. But that's what it's going to require. If you have as much or more money to put down as what you expect to net, then we can do the warehouse relinquished. Or if you've got a lender that's just not going to allow it to get done, then we have to do the warehouse relinquished. So in that situation, these two courses of action are also explained sort of exchange first or exchange after. And exchange first means that we're going to do a warehouse relinquish transaction. And the reason I say that is the taxpayer is going to have the money, and I guess I should back up too. We're not going to do a reverse exchange unless the taxpayer's got the financial ability to get this done. We're not in the business of loaning money. So, you know, as far as this transaction, you have to have the financial ability to get the deal done to do a reverse exchange. So if we're doing a warehouse replacement transaction, and let's say you've got, you know, 300,000 to put down, you're netting 400,000 out of the old property. The warehouse relinquish, you're going to show up the purchase with the 300,000. We're going to close that property. We're going to be entitled to that property. And then when your property sells in the future, the 400 is going to come into us. We're going to pay down that loan on that new property with the 100. We will then convey that property to you, and you've got the full amount in there. The balance of that money is just going to be used to repay the debt we've got to you. So on a warehouse replacement, the exchange actually happens when the relinquished property closes. On a warehouse, a warehouse relinquished, the exchange happens last. The warehouse on the replacement transaction, we're actually going to be looking at, I'm all twisted. I need somebody to help today. Anyway, warehouse relinquished means we're taking ownership of the relinquished property. So we're going to buy the new property. The exchange is going to be done at time of acquisition. So you're showing up with the money, we buy the property, warehouse relinquished, you're taking ownership of the new property, it makes the lender happy. You're going to do that if you've got as much or more to put down, or we've got a lender that's not cooperative. So when we buy that property, we're going to own it until you sell your property. We're going to then transfer the property. The warehouse replacement is an exchange first transaction. We're going to buy the property and immediately transfer it to you. The relinquished property comes to us, and then we sit on title to it until it goes away. So those are the way we do those two transactions. Once again, you've got to have the financial ability to make the deal happen and to get you where you're going. I'm sorry I got my tongue twisted up in that thing, but that's the reality of it. So we've got warehouse relinquished or warehouse replacement. Bottom line, we're not going to do the transaction unless you've got the financial ability to get that deal done. It's a complicated deal. We need cooperation with lenders. Most people have debt on property, so we've always got that lender component that's going to be there. And one other comment, I guess, and it probably should have talked about on the napkin test. When we look at a property going away, a lot of times people will take a property, or they'll take a HELOC maybe. So the lender says, hey, gee, you know what? Money's cheaper if you take a home equity line of credit on the property. Instead of financing the new property, we're going to take a HELOC on your residence, use it to buy the property. When you sell that property, is that HELOC debt on the property? No, it's equity. So a lot of times when people use HELOCs to buy something, they want to take, when the property sells, they want to repay that HELOC. And you've got to understand that's a problem there, because that HELOC, when used to buy new property, the HELOC looks like equity, not debt. So when we go to sell that thing, you've just got to be aware of that. I just looking at the 180 days too. The 180 days, this time of the year, you've got to look at on a delayed exchange or reverse exchange. It's 180 days or the due date of the tax return. So if we're looking at a sale this time of the year, whereas 180 days is going to be shortly, it's going to be starting to push up against April 15th. So I had somebody, and some people, not me, I mean, it seems like we're always filing extensions, but the deal is some people will actually file a return in January. All right. So the only time this in 30 years has been a problem, it was with a broker that I did lots of transactions with. He had a partner that wasn't familiar with the rules, and they entered into an exchange late one year, and the partner filed a tax return in January. As soon as the tax return was filed, the exchange was done. So it's really important. The fine print of the code says you got 180 days or the due date of the tax return. So if you're in a situation where you're doing a transaction late in the year, understand that especially when we get in November, December, if you're going to be buying after April 15, you got to file an extension in that situation. Second homes. Can you do an exchange of a second home? The answer is definitely yes. We've always done them, but we got some guidelines, got a revenue procedure in 2008, 2008-16, and finally they ratified the exchange of a second home. Now, when we talked about holding periods, what I talk about with respect to the holding and seasoning periods, I said there's no timeline there, but 1 year is what I suggest. So we don't have timelines with an investment property, but on a second home, if you're treating and you want to do an exchange of a second home, you've got to restrict your personal use of that property to 2 weeks or 10% of the time it's rented, whatever's greatest for the 2 years pre-disposition and the 2 years after acquisition. So, I mean, it's just ridiculous. I mean, you've got 4 years of restricted use. My advice is just stop using it entirely, treat it as an investment, and then you're looking at 1 year worst case, maybe less, depending on what your tax people are saying. But once again, anybody that's out there, if anyone tells you, no, the code says 2 years, it does not. It's only in a related party transaction. Partnership transactions. This is the reason that we have so many problems with vesting. All right. Now, let's say a group of us goes together, buys a property. All right. We buy it. I know we're not going to own the thing forever. So if we buy the thing, let's say we get a group of people together and we create a limited liability company, and that property now is owned by the limited liability company that has, let's say, 5 of us as its members. All right. Now we go to sell it 5 years later, or maybe one of us wants out. If one of us wants out, we're just going to tick out that person. So we're going to take a tenancy in common interest. We're going to take that person out of that property, out of the LLC, let's say, and assign them a tenancy in common interest in the property. They're going to need to hold that thing for a period of time. Once again, that period is up to you and your tax people, and then you could relinquish the property doing an exchange. But if everybody just wants to go different directions, out of that LLC, partnership interests are specifically prohibited from 1031 treatment. So that's the reason for tenancy in common structure. The problem with tenancy in common going forward is a lot of times that some of these lenders after the last crash just took that ownership structure as a problematic because of institutionally offered investments. Now, the structure itself isn't the problem. The assets are the problem, right? So, I mean, who's buying it for what and what are they doing with it? That's where the issues are. Tenancy in common is great. It's been around forever, and it allows joint ownership and allows people to exchange into and out of a property. So that's what we like to see. But if we're looking at a formal partnership, a limited liability, I'd never own a property in an S Corp, C Corp. It's just problematic for a variety of reasons. But if you've got an LLC or some other legal partnership, you've got to understand that interest is specifically prohibited. So we've got to do either a drop and swap or a swap and drop. A drop and swap just means we're going to deed it out from the LLC into the tenancy in common pre-disposition. If you're asking me, I'd tell you, do it a year in advance, but so often it doesn't happen because it's expensive. It's cumbersome, time consuming, different tax returns, lease agreements, all the different bank account, all these different things that have to be done to effectively break that legal partnership. So 9 times out of 10, it happens at closing, which is pretty tough to defend, honestly, if you're audited, because how do you say you personally held the property for investment if the whole time you owned it, you had a sale pending? So if you've got questions on this thing, give us a call. We'll go through it. We'll give you a lot of different case law covering it and sort of arm you with some tools to talk to your tax people about it. But this is once again why tax people are so important, and you want to talk to them pre-sale. You want to make sure you're having these conversations with your tax people in advance. Let us help you with those conversations. Drop and swap means we're breaking it first, going forward, tenancy in common. A swap and drop means we might go forward using the example I gave you with, let's say, 5 of us are relinquishing a property via a limited liability company. We might create 5 new LLCs that our exchanging entity is the sole member of. A year after acquisition, we just do an assignment of membership interest from the LLC to each of us personally on each of those respective properties. So that's an easy way to, get people where they want to go on acquisition. The downside of that is that often people just are tired. They want to go different directions. They don't want to own things jointly anymore. And then if you've got financing in place, you're sort of encumbered, obviously, with the swap and drop where you're not with the drop and swap. So if you've got questions on this topic further, give us a call and we'll do what we can to help you or you and your clients get where they need to be. Exchanges with related parties. All right, we've talked about holding periods a few times now, and I mentioned that 2-year hold is only in respect to a related party transaction. So we're looking at related party transaction. Who's a related party? Lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. All right. So, and by the way, you can't buy something you already own either. I mean, that's just something that you can't do. And that question gets asked all the time. In this situation, you can sell to a related party. You cannot buy from a related party. The sole exception is if both you and the related party are doing exchanges and both of you hold your respective replacement properties for no less than 2 years. Other than that, stay away from a related party on acquisition. Once again, a sale to is okay, buying from is not okay. Improvement exchanges. So they work like a warehouse replacement. So in that situation, we're going to create the LLC. We're going to close on the acquisition property just like we would in a warehouse replacement reverse. And then we're going to do those improvements. All right. When the improvements are completed, or we've met your exchange value and equity requirements, or we've run out of time, we're going to transfer ownership of that replacement property to our client. And whether we're talking about warehouse replacement, reverse exchange, or an improvement exchange, we can transfer that property to you 2 different ways. One, we can just deed from our entity over to you, completing the transaction, or if you've relinquished the property in a disregarded LLC, or you own things personally, directly or via an LLC, we can just do an assignment of membership interest in the LLC of that replacement property to complete the transaction. I like that because we're not changing title to the property. If you got a title policy in place and somebody didn't put you on as an additional insured, it takes care of that problem too. And if there's, it just takes care of things, cleans it up. You don't have to have a new deed drawn. Your lender's happy. Nothing's got to change. So the loan doesn't have to go from that, that entity to be redrawn individually or whatever might be the case there. So I like the assignment of membership interest for a variety of reasons. Does the property have to be complete to satisfy the exchange, an improvement exchange? The answer is no. Only what is complete qualifies towards the exchange. So you couldn't get to day 175 and have $100,000 sitting there in the exchange account and go prepay labor and materials. That does not qualify. So only what is real property at the 180th day is of like kind is going to satisfy the exchange. But the project does not have to be complete. Maybe it's just the foundation. Maybe that's done and that eats up enough of the value to take care of your exchange. That's fine. Otherwise, we get that 180th day, we've got money left. That money is going to be taxable to you. But we just need to be on title to it until the exchange is met, value equity requirements, or we're out of time. So one of those 2 things is going to complete the transaction. It does not have to be completed. Improvements don't have to be completed, but what is completed only as real property qualifies. So for my friends on the West Coast anyway, especially in Oregon, if you sold a property and wanted to go build something, or just wanted to build something today, how long does it take you to get a shovel in the ground? These are not exactly, as they used to say in the Obama administration, shovel-ready jobs. All right. The problem we've got, especially in Oregon, is you're not going to get a shovel in the ground until the exchange is over, probably. So in Oregon, you've got so much restriction that how are you going to build something you want? Well, maybe you own a piece of dirt that you've gone out and gotten the plans, engineering, permitting done, and you're just looking to see how you're going to do this project. Well, maybe the proceeds from a property that's going to be sold via 1031, maybe that could take care of it. So a leasehold improvement exchange allows us to improve property that's already owned. And what we do, we used to do it pre-2000. So the Rev Proc for reverse exchanges, one of the safe harbors was you couldn't receive property already owned as a replacement for property being relinquished. So we had to figure out a way around it. The 30-year leasehold interest takes care of that. So what we're doing today is we'll create the LLC to take a leasehold interest in the dirt that you've got. When your property sells, as it normally would via any exchange, the proceeds are going to come to us. And just as any other exchange, we're going to take those proceeds, go vertical on that dirt, and what we complete on that leasehold basis is by law like-kind real property. So when we reach your exchange value and equity requirements or run out of time, we're going to assign the leasehold interest back to you, completing the exchange. And now you've got improvements on property already owned. That's a pretty cool deal. It's not something that's commonly done coast to coast. There's not many companies in our space that are going to do it. As far as Oregon's concerned, for example, we've got in the state's practice manual, this process is actually spelled out. So the continuing ed of the bar in Oregon has a leasehold improvement exchange in the 1031 practice manual for the state bar, which is very nice for us. So, but this is something that we're doing a lot of just because of time and what's going on. And a lot of times people today are saying, hey, I've got this dirt, I'd like to build it out. Notes in an exchange, and you know, we're creeping up on this hour real quickly, so we've got some more distance to go. If you have to sign off at the end of the hour, fine, do that. Just keep an eye out for this packet because it's going to contain a lot more information, some examples. But the notes in an exchange, a lot of times people say, well, gee, I was told I couldn't do an exchange if I'm carrying a note. Totally incorrect. There's 5 different ways to deal with it. Bottom line is the note is just like any other consideration. The note's not like kind, just like cash isn't like kind. So if we've got somebody that wants to defer everything and do an exchange with a seller carryback, just as the cash would come to us at close, the note's going to come to us, right? And then we've got a choice. What are we going to do with it? Somehow we have to convert the note to something that's usable for the acquisition of the replacement property. So a lot of times we can sell to a third party and you know, that happens, but you know, the discounts on notes often are greater than the tax consequence. So that's something that's not that attractive for people. Second choice would be use the note to acquire the replacement property. Once again, it's possible, it doesn't happen very often. We've done them where we've cross-collateralized that because the seller of the replacement property doesn't know anything about your property, doesn't know anything about the buyer of your property. They just don't want the note. So that is possible, but rarely is it done. Third choice is our taxpayer, our client, the exchanger buys a note from us. You go, why would I buy my own note? That doesn't make sense. Well, what you're doing is substituting cash for the value of the note. So if you've got, let's say, you know, a note of $300,000 today, and it's paying you 5%, where are you going to get 5%? If you've got $300,000 sitting in the bank, what are you making on it? Probably nothing. So if you took a loan from the bank, what are you going to pay for that? Maybe 4%? So you're a point ahead. Even if I've had people borrow money from the bank to buy their own note. So that's a situation that comes up. But you know, that purchase of the note is what happens typically. So what'll happen when you buy the note is you're really substituting cash for the note. You're just going to show up at the purchase of the replacement property with the cash. It doesn't have to come to us. When you buy that property, we're going to convey the note to you. That cash that you're using to buy the note is going into the replacement property. And as long as you're meeting the napkin test, value equity requirements, you're going to be totally tax deferred. So that 9 times out of 10 is the way the transaction's done. Another situation where we might see a note is maybe the property you're selling needs some work. Maybe it needs a roof. Maybe it needs other stuff. It's not financeable. Well, you can do a short-term seller carryback. Give the buyer 30 days, 60 days, 90 days to get the refi done. As soon as the refi funds come in, you then have the cash to complete the exchange. So If you've got a short-term note that matures inside the exchange period, allowing us to get the cash to complete the transaction, that's also a very nice tool that'll get things done. In today's world, loans are different. You might get bounced out. The buyer might have a situation where they don't have the loan gets changed, and you need to get the thing done because you're purchased. Well, you do a short-term seller carryback or something. There's a variety of reasons that might come up, and it's possible to allow that to happen. Partial exchange. The last choice is maybe you're just doing an exchange of the down payment. You're going to pay tax on the note as the payments come in. And I guess a word of caution on seller carrybacks too. You got to understand that if you're looking at an improved property that you're relinquishing, you're going to have tax exposure. Even if you didn't receive a single principal payment, you're going to have tax exposure on debt relief and depreciation recapture in the year of disposition. Don't think that you didn't get any cash down payment. And by the way, the broker's going to get paid, the escrow is going to want to get paid, I'm probably going to want to get paid, people are going to want to get paid out of closing. So make sure you get enough to cover all those closing costs plus your tax liability if you've got depreciation recapture and debt relief in that thing. Make sure you understand that, and if it's good, great. And a seller carryback, note trustee, land sale contract, those things are great end games. Maybe you don't want property, you're comfortable with that, and you want to set up a note that's going to pay you over the next 10 years. Make sure the note goes 10 years. Make sure you've got an acceleration provision in there. But that's a nice income stream for somebody at the end of the day. That's an end game. Dealer status. So we all hear the ads for flipping property, okay? People flip properties, they're gonna get tired of paying the tax, okay? I got into this business because we did modified flips, and I don't know, I've seen what we do. Somebody came out with some acronym for it in the last couple of years, and they touted as this new idea. It's not new, it's been around forever. You buy a property, you fix it up. Instead of selling it, you're gonna fix it up, you're gonna do a cash out refi, you're gonna season it as an investment property for a year or so, and then you're gonna relinquish the property via an exchange. Why do it that way? Because one, if you just buy and turn a property, you're paying normal income tax. That thing's not an investment. I don't care what you say. Even if it took you 2 years to improve the property to sell it, it's taxed as normal income. It's a dealer property, okay? So you got to look at that and understand what's happening with it. Time is not the difference. It's what you're doing with this asset. If we look at the Clarkowski court case, you look at these 9 points. The purpose for which the property is acquired, the purpose for which the property is subsequently held, the extent of improvements made, the frequency, number, continuity of sales, the extent and nature of transactions of the property, the general business activities of the taxpayer, the extent of advertising and promotion of the property for sale, whether the property is listed with a real estate broker or other outlets. 9, the purpose for which the property is held at time of sale as opposed to time of acquisition. I'm not concerned if you've got 1 or 2 of these things against you, but a dealer's going to have most all of these things against them. And once again, it's up to you and your tax people to decide whether the exchange is relevant, whether you're paying normal income tax or long-term capital gains tax. And once again, this next election is going to be very important because maybe those 2 things are the same thing after the election. So be aware of that. But you're really in a situation where if you look at just flipping a property, you're looking at normal income tax on disposition. So look at what you're going to be netting net of taxes. Don't look at what you're just making on that property because you're going to lose a huge chunk of capital to taxes. If you do that modified flip, you're buying, improving, holding, the money that's available via the cash out refi often is going to be in excess of what you'd net after paying the taxes. So you're not losing anything. You're gaining an asset and you're snowballing those assets via 1031 over time. You wouldn't believe over the 30 years how often we've done this for different clients. I've had clients for 30 years doing this kind of stuff. Start with nothing, and now they've got a very nice portfolio of properties. So once again, time is not the issue. It's what you're doing with that property during the time you own it. Few examples, and then 1 page talking about end games. We're done here. This guy came into us, and this is sort of, I'm giving you a couple different things that we do. This is sort of creative in that this guy came in just giving up a 7-Eleven store, and he was exchanging out of Oregon into Texas, all right, which happens all the time for a number of reasons. But this guy was, going to go buy some fast food stuff down there. And as he started looking, he was thinking, gee, I want to buy more. And so he had more that he needed than what he had coming in via the exchange to buy these properties. So he contemplated using some of his IRA money to go do it. So what we were going to do in this transaction, as I said earlier, the exchange does not allow you to exchange in and out of a partnership interest. So you couldn't go in and out of a limited liability company. So what we did is we were looking at doing the acquisition, tenancy in common. He would literally be a co-owner of that replacement property with his self-directed IRA account. Ultimately, we didn't do this deal because anytime you've got IRA or 401k money into a real estate transaction and it needs a loan, it's got to be non-recourse debt. What I mean by that is the only recourse in a default is for the lender to take the asset. They can't go after you, can't go after anything else you own. And ultimately, a lot of times we have problems with the bad boy carve-outs and non-recourse loans. So you just got to understand and work with, if you want to take IRA 401k funds to buy property, you need to work with a lender that understands what's involved with that and is going to take care of you. If you just go out and get a regular loan, that's a prohibited transaction. It blows up your IRA. So what happened is with the non-recourse, the cost of funds was going to be higher. He ultimately decided not to do that, just bought the property. We ultimately did do a self-direct IRA for this guy, went out and bought the property, bought another property with retirement funds. But once again, if we're combining 1031 with other people or any other source of funds for that matter, whether it's IRA 401k money or a friend or whatever it might be, you're number one, you're going to ID the portion of the property you're buying with the exchange, not the whole thing. And number two, it's got to be a TIC structure, not a membership interest in another partnership that's buying that thing. Second example, and this happens a lot in today's world, 1031 is not all or nothing. Anything you receive that's not of like kind is considered boot and taxable. As soon as the boot received exceeds the total amount of gain, then there's no benefit to the transaction. So in this transaction, these people came into us, gave up a $3 million apartment building, got a $1 million property in the desert, and that's all they wanted. And you're going, gee, that's ridiculous. We've got a situation where you're going from 3 to 1, you've got $2 million in boot. Yeah, you're right, $2 million in boot. But we had a situation where we're looking at still deferring tax. The basis on the relinquished property was $250,000. We had $750,000 in gains, saved them $250,000 in taxes. So look at what you want to buy, whether you're the broker looking at what your client wants to buy, or you're the taxpayer, you're the exchanger wanting to do the exchange. Understand that it's not all or nothing. Buy what you want to buy and understand when the exchange is going to stop making sense. And what I always tell people is the only reason basis is important is calculating whether or not the exchange makes sense. Basis has nothing to do with what you have to buy in an exchange. All we're concerned about is satisfying the napkin test across or up in value and equity. So in this situation, like I said, they went from 3 to 1, had $2 million in boot, deferred tax on $750,000 of gain, saved them $250,000 in taxes. That's what they wanted. Get what you want today. A lot of times we have transactions right now. This is an uncertain time. You might want to pull some money out. Understand that's possible. That's fine. You can pull it out. Maybe you have a loss somewhere else to offset the gain. Do that. But it's not all or nothing. Buy what you want to buy. Every dollar more you spend on something that you want costs you a buck. If you don't spend it, maybe it's 30, 35 cents, at least today. Opportunity 3, okay? Understand equity has nothing to do with gain. Gain has nothing to do with profit. In this situation, okay, and we're going into a period of time, I expect next spring we're going to have lots of real estate with lots of problems. I mean, if you look at retail, you look at office, I mean, anybody working in office buildings, working in a ghost town, the retail is sort of similar. We've got people where we haven't had to pay rent, for months now, and they're told they don't have to pay rent till March. If they don't have to pay the rent during that time, they don't have the money, then they're not going to have it in March. So you're going to have people with situations where they're needing help. Understand with income properties, you don't have to have profit to have tax. If you've got something called phantom gain, you're going to have tax exposure even if you have a loss to a short sale or even a foreclosure. So if you lost your primary residence to a short sale or foreclosure, you've got some tax relief that's there. Income properties, you don't. So phantom gain is a situation where the debt on the property exceeds the basis on the property. In a foreclosure, the debt is treated as a sales price. In a short sale, you're just going to look at what's greater. You know, in short sale, by definition, you got that problem. So you're going to look at, you know, what that debt is on that property is going to be treated as the sales price. And your gain is simply that debt minus the basis. So you could lose a property to foreclosure, so you lose the entire thing, and the ultimate insult is you get to pay taxes for the pleasure of doing such thing. So what we have done, what we did the last crash, and honestly, it took about a decade to work out all through the problems. About 2 years ago, I think it was the last time we did one of these. But especially like an institutionally offered TIC, those things are all a series of single member LLCs, tenancy in common. And we would just do an assignment of membership interest in that entity pre-foreclosure. So the taxpayer transfers it to us pre-foreclosure. That way, when the foreclosure happened, we isolated in that transaction our client from debt relief. And they just need to go out and buy a new property of equal or greater value to what the debt was on that relinquished property. So once again, we're not getting any money. We're just isolating our client from any debt relief, which saves them from that phantom gain. And you know, I haven't had any of these coming up yet, but I would expect if things don't change in another 6 months, we're going to start seeing these things happen. And it's just something to be aware of. If you're a broker, make sure your clients are aware of it. If you're a taxpayer, make sure that you're aware of it. Don't think, hey, gee, I just lost this property, I don't have any tax. Your tax people, once again, talk to them, make sure you understand where you're going with the thing. Last example, this one, I'm throwing you a curveball. I'm enticing you to come listen to the next webinar on IRAs and 401k plans. So you know, when we have situations, economic chaos like we've got people losing jobs, and they might get access to 401k funds that they didn't have the right to until they were 59 and a half. Maybe they've lost a job, maybe they've lost a job, they don't have anywhere to go, and maybe they want to buy a new business. We can do what's called a rollover business start. We can literally create a new business owned by a retirement account that by your own retirement account, in fact, and you can work for it. So in this situation, a husband and wife retired, came to us. They said, look, we've got IRAs. We'd like to take our IRA money, go out, buy this mobile home RV park. So, you know, you could do that just as an investment, obviously. So we started talking to them about what's called a checkbook IRA, and we were looking at that path. Then they said they wanted to be the on-site managers and you know, manage that asset too and live there. And both those things would be prohibited transactions you can't do. The rollover business startup allows that to happen. So we took their IRAs, instead of going into more IRAs, we took the IRAs, went into a 401k plan. The plan bought a C Corp, the C Corp bought the park, and these people got an investment, they got a job and a place to live. And I think that is just an amazing transaction. So, you know, never say never on this stuff. The only dumb questions one you don't ask. Call us up, ask those questions. We're happy to, you know, address those and help you get where you want to go if it's possible. End games. Swap till you drop. Okay, that one we've got to keep an eye on the election, because if they get rid of stepped up basis, that goes away. Right now, you could exchange, and when you pass away, your heirs will get a stepped up basis on the property or properties, and they could sell the next day with no tax consequence. It's a wonderful tool. All right, swap till you drop. Second, exchange into retirement residence. So you buy a property, hold it as an investment, move into it. You know, once again, we've got some rules there, but if you're going to live in it for the foreseeable future, there's no tax consequence on that. Once again, you exchange into the property, hold it as an investment, move into it after a year or so, whatever your tax people are comfortable with, and when you pass away, they get stepped up basis once again. Exchange till it makes tax sense. What do we mean by that? Maybe you've got losses elsewhere to offset the gains on disposition. That's what we mean about that. Exchange into a passive investment. DSTs, there's institutionally offered TICs, too, tenancy in common. DST stands for Delaware Statutory Trust. And really, I describe it best as an exchangeable real estate investment trust. So you're exchanging into a portion of a portfolio of properties. It could be one, but typically it's going to be a series of properties. And you know, it's totally passive for you. So people that are tired of the terrible T's, toilets, trash, tenants, turnover, that's where you can go. Installment sales. We talked about installment sales. You now know the tax treatment on that, but that's a great way for an income stream over time. A structured sale is just an institutionally structured installment sale. So a third party assignment company assumes the obligation to make those payments for you over the term of whatever you choose to have it. So instead of selling on a contract, worrying about a default or worrying about acceleration of the payments or something like that, you can do a structured sale. It's with a third-party assignment company. It's somebody like a whole life company typically, and they're going to term that note to the term you want it to be, and you don't have to worry about them defaulting, at least in extreme circumstances. CRT, charitable remainder trust. Look at your favorite charity. Could you give your favorite charity a property and have some beneficial tax consequences? Certainly. Call us about that. Tina in my office worked in that space for about a decade. She can help you out. Green energy deals. I mean, typically they're structured TIC or DST, but if you're all in with green energy, you want to buy into a wind farm or a solar farm, there's companies that package those things. You can do that stuff. Gifting. Got 3 kids, you want to give them each a property, fine, do it. Go buy 3 properties, in LLCs maybe. So you're the member, a single member LLC, each of those properties, and then during the next several years, you start gifting an interest in each of those properties. If you gave somebody a property, what are you doing? You're giving them all the equity in the property. That's a gift. Any gift in excess of $15,000 per person per year has got tax consequences. People don't think about that. I have people deed properties back and forth all the time. They don't even think about it. That's a gift. So understand that. But I've got a great strategy for you. If you're buying something for the kids, instead of giving them the whole property in a single year, give them a membership interest in the LLC. Give them a membership interest, a minority interest in that LLC, and the valuation of that membership interest is going to be discounted up to 40% because they don't have control of that asset. So by gifting, you can apply discounting, and you can actually accelerate the transfer of an asset while minimizing the tax consequence if you're gifting a minority interest in an entity over a series of years. If you got questions on that stuff, give us a call. That's the last page that we've got in here right now. As I said, we've got 2 different companies. We got a third, a post 1031 website. I'm going to look at a couple. For those of you that are on the call right now, the presentation is over at this time. Once again, if you need credit hours, reach out to Seymour at 1031 Exchange. I apologize, this frame that got cut off at the bottom there. Seymour at 1031exchange.com. If you got questions, she's going to be sending you out copies of the presentation. But I'm going to just go through your questions real quick right now. I've got you out there. If you want to get off the phone, fine, do it. But so let me look at these. I've got to find my glasses real quick. It's sort of small. I've got a question from Debbie that says, the good news is, okay, all the things say in advance, often easier said done, nearly impossible to execute. I remember if you used Mexico was fine. Okay, well, so I guess we're not really talking about 1031 stuff, but I guess what I would say is, the one comment in this about like Mexico, people ask all the time, can you exchange out of the United States, into Mexico or someplace like that? And the answer is no. It's domestic property for domestic property, foreign property for foreign property. So just be aware of that. Anytime you're doing an exchange, it's domestic for domestic, foreign for foreign. So if you had Mexican property, you want to do an exchange into another one, we could help you with that, but we can't go from US into Mexico or vice versa. Second question, Mike asking about the 45 days. Why is there only a 45-day window for ID purposes of the 1031 exchange, 180 days to close? Really limits the investor. It's there to trap people. It's really been frustrating for me over the years. Like I said, I've been doing this 30 years, and it just puts good people in a bad spot. I mean, it's a lousy deal. The one thing I will say about it is that it sort of, human nature is procrastination. So the people, a lot of brokers I work with, their concern is if you got rid of the 45 days, people are just going to be pushing up against the 180th day all the time. I don't necessarily agree with that. I just say, Mike, to answer your question, it should just be 180 days, but that's not the way it is. And, look at why 45 days, why those 3 ludicrous ID rules? I mean, they're crazy. So, I mean, there's no reason to it. Some senator wanted to propose it, and here we are stuck with it, right? So that's why it's there. Don't apply logic to what they're doing. It doesn't exist. You have a second part of that question. What's the purpose? Seems long as new ID. Yeah, I agree. I mean, bottom line is if you're completing the transaction, you're completing the transaction. I mean, I can see where they want a 180-day time, but the 45 days, like I said, it's just there to trap you. The one additional benefit to having it is if you look at the 1031 G6 rules, if you didn't have the 45-day ID period, you'd be in a situation where you could not, if you start an exchange, you couldn't get the money till day 181. So I guess there's a positive to that 45-day. I'm searching to find positives, Mike, but that's one. Anyway, John, you've got a question. How do you recommend completing the project in 180 days if new construction? Organization and working with people that are going to get it done for you. I got a good buddy that ran one of the largest commercial, construction development firms here, and he went and built his house, and he just could not believe what was involved with building a house and just the problems. And anybody that's built a house, my general rule is, hey, it's going to cost you twice as much and take you twice as long. So, great question. Commercial, you've got spreadsheets, timelines, things that are going to happen, but it's about organization, and that's where that leasehold improvement exchange comes in, because you've got more control. If you're doing just a straight up an improvement exchange on a new piece of land, you're going to be hustling, and my advice is, get everything locked up. Ask for as much time as you can to sell your relinquished and to buy that replacement property. So don't let your relinquished property close until you're ready to get started, to make that purchase and get started on construction. Otherwise, you've got a problem. And furthermore, look at the time of year you're going to do this stuff. I mean, I grew up in Santa Cruz, and if it's a big swell, the contractors are surfing. They're not out there working. I live in hunting country now, so depending on the time of the year, your hunting season opens, you're going to lose a bunch of people. What about the weather? I mean, so make sure that you're timing your closings during the time of the year you're going to be able to get stuff built, number one. And number two, you're working with people. Three, you got to make sure those timelines are going to be watched. So don't let things close until you know the best you can where you're going. And I guess, some large scale stuff. I mean, if you're building some big facility, just the cost of steel and everything, you can burn through a pile of money very, very quickly. All that finish work is what takes all the time. But it's organization and timing. Do what you can to time that thing and fit your needs. It's your job to ask for the time. It's the other people's job to say no. But it's always going to be a race. Son, you just asked whether you're going to get the email or the information. Yes, you are. Debbie, you followed up. I was commenting on your comment about these things are all going away. Yeah, I mean, we don't know. I'm just saying this is what, and like I said, I don't want to get in politics on it right now. This is just the first draft on stuff. And honestly, it seems like every 4 years, every time we've got an election, somebody's threatening to get rid of 1031, and it's been around for 100 years. So, I'm just telling you what I see, what I know is out there right now. And if you're in the real estate world, you better be ready for a fight. NAR is the reason, National Association of Realtors is the reason we survived the last one. So, it's there, and just, be aware of it. And anyway, so I just took, and I understood, Debbie, I just took your question to open up the opportunity of domestic and domestic, foreign and foreign. Mr. Nelson, how about ding a DST? When you're looking at the DST stuff, you gotta, look at, and I'm not quite, how about IDing a DST with numerous properties? So, that question, Bob, is something I continually, anytime I get a chance to talk with a DST sponsor, I asked them, I said, look, why don't you guys request some type of position from the service on what would satisfy a satisfactory identification for DSTs? Because as I mentioned, when we were talking about DSTs, it could be a single asset. It's more often than not a series of properties. So I've got two comments with respect to that. One, understand where those properties are. Every state, if you've got a DST with properties in 10 states, you're filing 10 different tax returns. So be aware of that. most of the sponsors are going to do their best to package that, those 10 properties in a single state. Maybe you want that, maybe you don't. DSTs offer you the ability to diversify not just geographically, but also asset class type. So, I mean, you can you give up a rental house and go out there and buy, well, nobody's wanting to buy hospitality stuff right now, but mini storage or mobile home parks or, whatever it might be. You like multifamily, do that. If Flex Industrial, do that. I mean, you're going to package whatever you want in there. But what Bob's indicating or asking is the idea itself. If a DST has 10 properties, are you IDing 10 properties or one? And my position on that is it's one. And I say that, and it's my position. I say that because you don't have the ability to pick and choose any one of those properties. You're getting one or none, or you're getting 10 or none. I mean, you're getting one DST offering that contains 10 properties. That's one thing. You can't say I want property 2, 3, and 4 of those 10. You don't have that choice. It's all or nothing. And we sort of have that. The reason I applied that logic to this is you're going to have sort of the same situation if you're buying a property. Maybe you tied up 12 fourplexes, but they're all on different tax lots, and it's all one seller and it's all one purchase sale agreement. Do you have the ability to break out any one of those things? Is it 1 or is it 12? And that industry is struggling with it because there are lots of people in our industry that'll say, okay, the DST contains 10 properties. You're IDing 10 properties, even though it's one offering, which automatically kicks you into the 200% rule, or more often than not, the 95% rule. So that 45-day period is more important than ever before. So this is not something, Bob, you're introducing something that's quite a conversation. And there's no black and white answer, but it's somebody's working with us. We're going to treat it as one. I'm going to say, hey, have a conversation with your tax people in case anybody ever needs to fight and defend that position. But that's the way I'd look at it. So one last question. We're going to be signing off. I'm going to be giving everybody an hour and a half if you're Oregon for CE or anybody else too. So in a 1031 exchange, I paid off the mortgage about 5 years ago. I'm selling a property now and may do an exchange. Anything I should be aware of, or is it normal exchange? No, Garrett, I guess you're in a situation where I would apply what I said earlier. If you've got debt-free property you're relinquishing and you want to leverage into the replacement property, I would say, or buy multiple properties, I'd say, let's complete the exchange for you with one property. Buy a new one outright, do a cash out refi of that property, and then buy all the other properties. Because by doing that, we're getting away from all those ID rules. We're getting rid of that basis carry forward. A lot of times people call 1031 as a tax-free exchange. It's not. It's a tax-deferred exchange. So whatever the basis was in the relinquish is being spread across the replacement properties. If you relinquish a property of $100,000 in gain, just take 100 off the replacement properties purchased. You're going to have roughly the basis in that. But your basis goes forward. So by doing what I'm saying in this situation, Garrett, if you can complete the transaction with one property, do the cash out refi, you can put money in your pocket, take a trip, buy a boat. We need our boat, or just take the refi money, go leverage into other stuff, and you're going to be fine doing that. But it's all up to you, obviously. But no, I mean, you're relinquishing a debt-free property, go out and buy a new property of equal or greater value, and you're going to be just fine with that. Thank you very much, everybody, for joining us today. I hope you found it helpful. If you are confused on some of the basic stuff, don't hesitate to sign up for one of our the basic classes too. We're going to take all those 4 cornerstones, go further, deeper with them. But I'll throw this out to you too. Anybody that's got questions on anything specific, if you'd like to see a presentation on something or get more information on it, first off, you can take a look at our YouTube channels. Just type in Equity Advantage 1031 Exchange or IRA Advantage Self-Directed IRAs. You can find lots of information up there. And it's not just on exchange or IRA information. We've got everything on even charitable remainder trusts, life policy, life contracts. We all hear those ads all the time or see them on TV too. And we've got information up there on that stuff. So we're trying to really provide information for our people, not just on the things we do, but things that are interesting to investors. And if you've got something you want to know more information on, like to see addressed, please don't hesitate to reach out. We're happy to help you out in any way we can. Once again, David Moore with Equity Advantage, 1031exchange.com, and all my best of health to everybody, and I look forward to talking with you soon. Thank you, and all my best. Take care. Bye-bye.